not the United States. An interesting thing about the United States, the U.S. gold supply went from about 20,000 tons in 1950 to 9,000 tons in 1970. Then there was a run on the gold bank. It dropped even further. That's when Nixon shut the gold window in 1981.
So let me ask you this, Jim. The last time we spoke was in April. Is it safe to say you're more worried today than you were then, or even say a year ago?
Well, no, a year ago I was saying that the economy was weak. I mean, my last book, Aftermath, came out in July 2019. So it's just a little over a year old. It's not like it wrote it 5 years ago. That book's a little over a year old. Go look at page 288 to 291. I talked about pandemic. I said 100% chance I had two other scenarios. So 100% chance one of them happens in the next 3 years, and pandemic was on the list. So, and I also talked about civil unrest and armed militias in the streets, which we're seeing every night. So everything that's happening now, I forecast in my book, Aftermath, which came out in July 2019. You can just go look it up. So my new book, The New Great Depression, is going to take the story forward and tell you what's going to happen in the next couple of years. But the deflation story is not new, Danielle. It's been persistent, and it's getting worse. The Fed does. I could tell you how to cause inflation in 15 minutes, but unfortunately, the Fed kind of forgot how to do it.
So you mentioned gold before, Jim, and a lot of investors are concerned with the metal because we're seeing these ebbs and flows, this volatility with the metal. But I want to bring up one tweet you recently tweeted, and I'm just going to read it here. You say, reminder, when stocks tank, gold goes down as leveraged players sell gold for cash to meet margin calls on stock losses and other illiquid positions. Once it's down enough, the strong hands pounce and gold rallies again. So I think that's a really interesting point, and I think a lot of people forget this is a similar pattern we saw in 2008. Tell us more about this, Jim.
Sure. I like to say there are two kinds of buyers of gold, or investors in gold. Generally, the strong hands, the strong hands and the weak hands. The strong hands don't use a lot of leverage. They use cash or capital. They're in it for the long haul. They're not day traders. I watch the tape because I'm an analyst. And I do a lot of interviews about it, and I write about it. But I'm not a day trader. I don't get too euphoric if gold goes up. I don't get depressed if it goes down. I know where it's going in the long run. It's going to the kind of neighborhood of $15,000 an ounce. But that doesn't have to happen next year, even the year after. If that's the trend, then I like to remind people, if it's going to $15,000 an ounce, which it is, it's got to go to 3,000, 4,000, 5,000, 6,000 along the way. So that's the long-term trend. So I don't worry too much about the wiggles. But yeah, as far as the stock market is concerned, and this happened, you're right, it did happen in 2008. I remember the worst part of it in 2008 in September, October, November, when the stock market was absolutely crashing. Gold was going down, and I was getting all these calls. Hey, Jim, gold's a safe haven. How come it's going down? But what happens is, in a liquidity crisis, everybody sells everything, especially the weekends. If you're leveraged and you're in the gold futures market, and you're long and the market's collapsing, you got to sell. You got to get out. You got to cut your losses. But also, if you're losing money in stocks and you're losing money in mortgages, which was the case in 2008, today, as we saw since September 2nd, the market's down substantially. People get margin calls. If you're a leveraged player, you got to either come up with cash for the margin, or you have to sell your position, which makes it worse. So what people do is they sell gold to get cash to meet the margin call on the stock losses, or they're on the wrong side of the gold market and they're leveraged and they just sell and cut the losses. So it does go down. It's highly predictable, but the strong hands are waiting. It's like if you've ever seen a lynx or a mountain lion hunt, they don't stalk their prey, they just wait. They sit there and wait, and then they pounce. Strong hands are watching. They don't jump in on day one. They wait till it goes down enough, and then they come in and buy, and it goes right back up again.
So would you put Buffett in that category?
Well, Buffett's a little different. I think he did buy a big stake in Barrick Gold Mining recently. I think he's more of a fundamental. He's not a market timer, certainly. I don't think he's much of a technical analyst. He is a fundamental analyst, but he saw something. Yeah, I would put Buffett in the category of strong hands. But Buffett wasn't around. Right, he was around, but he wasn't buying gold in 2008. He wasn't buying it in 2015 when the stock market went down sharply. But if you, again, look at every one of these instances, Danielle, you'll see that the immediate reaction of gold was down, and it finds its footing, and then it goes straight back up again. I fully expect that to happen again.
So are you defining central banks as the strong hands?
Yes. Now, you have to pick and choose your central banks. Who are the buyers? Well, Russia and China, we know they've both tripled their gold reserves in the last approximately 11 years. But Vietnam, the Philippines, Mexico, Kazakhstan, they're all buying gold. And more importantly, the central banks with the larger holdings have stopped selling. Now, the Swiss National Bank, the US Treasury, the Bank of England, they're not in the market buying gold, but they're not selling. And they had been for really 30 years between 1980 and 2010. They had been net sellers the whole time, not the United States. An interesting thing about the United States, the US gold supply went from about 20,000 tons in 1950 to 9,000 tons in 1970. Then there was a run on the gold bank. It dropped even further. That's when Nixon shut the gold window in 1981. But the US still dumped gold alongside the IMF between 1971 and 1980. But 1980, we just stopped cold. The US gold supply today is almost exactly what it was in 1980.